Hello there. Today we're going to solve an Igcse accounting paper 1-1 October-November 2021. Before we start, I advise you to attempt the questions first and then look at the solutions. Check if you got those right. Or actually attempt the whole paper, see how many marks you get, just to get an idea how well prepared you are, and then watch the videos. Just a little advice. Let's start. Why does the trader calculate the profit of his business? To calculate interest payable on loan, not the reason why you would calculate profit of the business. These answers are very logical. To calculate the provision for doubtful debts, not something that specific. To know the total expenses of the business, not really. Calculating profit is not connected to that. Although, you know, expenses are part of calculating the profit, but that's not why we calculate profit. To know whether drawings are at a reasonable level. That is true. As a business person, you need to know how much drawings you should take, what's a reasonable amount of drawings you can take if you know the profit, right? If the profit is not that good, you have to control the drawings, and if it's too good, then you can have a little bit of a free hand. You can take some extra drawings that period. Hassan is a trader. During the financial year, he took goods from the business for his own use, drawing of goods basically. How should he record this? So the account that is getting the value is drawings, and where it's coming from purchases. Okay, remember, goods for resale, purchases account records the goods for resale. So these were goods for resale. Normally when we make purchases, when purchases rise, purchase account is debited. But now the purchases, the goods available for resale are falling, so we credit the purchases account. Drawing account is always debited with whatever the drawings we take. Let's move on. Number 3. Where are the accounts of credit suppliers maintained? The personal account of your suppliers. They go in purchase ledger. This is just the basic knowledge. You need to know this. There's no explanation to this. This is what purchase ledger is. Purchase ledger contains all your credit suppliers, accounts of all your credit suppliers, all the individual personal accounts. Number 4, which document does a trader issue to remind a credit customer that payment is due? Again, this is something you need to know. No, there is no explanation there. It is what it is. Statement of account is a reminder to your credit customer. Credit note is issued when a reduction in invoice is allowed, basically when a return is accepted. Debit note is when a return is requested by the customer. Receipt is a proof of payment. When you make a payment, you may get a receipt. Number 5, what is a check counterfoil used for? To pay a check into the bank account. By the way, check counterfoil is like, a checkbook has two parts. So there's this dotted line. You fill this in, you give this to the person who you're paying the amount to, let's say your supplier, and you keep this counterfoil, right? As the one who's paying. To record a check payment in cash book. I think this is it. Because when you make a payment, you need to have a record. You need to have a book, a business document. So when you cut this off, this check off, you give it to your supplier. You as a customer, the one who's paying, you need to record this payment later on. So use the counterfoil, that's this part, to record it in your cash book. It's business document. Business document is where everything starts, right? So to record check payment in cash book. Let's move on. Number 6. Farouk sells goods on credit. A check from Khalid, a credit customer, was dishonored by the bank. How should Farouk record this? So we previously thought that we received money into the bank. Our bank was originally debited, Khalid was credited. Khalid, the receivable, fell. When the transaction happened, this is what happened. Bank debit, and Khalid, when he paid us. But now we realize that the check was dishonored. We have to reverse the entry. We have to say, well, we never received the money in the bank, so we credit the bank now. Previously it was debited, but now we credit the bank and we debit Khalid. That's all. We don't count it as irrecoverable. The check got dishonored doesn't mean we will take the expense. We will call Khalid again. We'll ask him, request him to pay the amount another time because previously it got dishonored. Let's move on. Number 7, Tumelo sells on credit. The terms of trade are listed. Okay, list price $200 per unit. Okay, credit period 60 days. Trade discount 15% if 10 units or more are purchased. 3% cash discount if debt is paid within 1 month. A credit customer purchased 20 units and paid the debt within 15 days. What was the total of invoice? Please guys, don't get tricked. Interesting question. Make sure you understand this once and for all, okay? For this one, you need to know the difference between trade discount and cash discount. Cash discount is allowed or received, if you're the customer, at the time of payment, right? At the time of payment, check or cash payment. At the time of payment, right? Trade discount is given or received at the time of transaction. And you know which document is exchanged at the time of transaction? Invoice. So this, although the person paid after 15 days, but that's not the question. The question is asking what was the total of the invoice. An invoice is issued at the time of transaction, not 15 days later. This discount was 15 days later. So this is irrelevant to this case, to this question. What was the total of the invoice? Well, the payment was even 3% lesser, but the invoice amount would be, well, 20 units were purchased. So 20 times list price is 200 each. Okay, let's check that. 4,000 is the list price. And then, of course, you subtract 15%. You subtract that. What is 15% of 4,000? 600. That's the trade discount, right? And so that's going to be 3,400. That will appear on the invoice at the time of transaction. This is due. But when the payment is made after 15 days, which is within the time period allowed, well, at the time of payment, we'll further reduce 3% after 15 days. But in the invoice, we will have 3,400. I think this question nicely explains the concept of trade and cash discount. Number 8. Jane purchased goods and paid by credit transfer, basically bank transfer, you can say. How should this be recorded in Jane's accounting record? Jane purchased goods and paid by credit transfer. So bank is credit. You know what? Only one option is available. That's it. How easy? It cannot get easier than this, guys. Jane made some payment. Bank is definitely credit because money is going out of bank. And B is the only option. That's all. It's such a nice question. Very easy. What is shown in a trial balance? Capital and profit on a particular date. If you have studied the chapter, this you wouldn't recognize this. This has nothing to do with it. Financial transactions for a particular period, not at all. It doesn't list transactions. List ledger balances on a particular date. That's the definition of trial balance. It's a list of balances on the ledger accounts at a particular date. Receipts and payments for a particular period, not at all. Number 10. At the end of each year, PT Limited transfers 20% of the profit for the year to general reserve. Keep this in mind, please. Draft financial statements were prepared. It was then discovered that inventory had been overstated by 1,500. Do you know how inventory affects profit? The closing inventory in specific? It increases. If it is directly related with the profit. So if closing inventory is higher, profit's going to be higher. Okay, how is that possible? How do you calculate, where does the closing inventory go in your income statement? Opening inventory plus purchases minus closing inventory. So you see, closing inventory reduces, it is subtracted from the cost. So if it is overstated, it means the cost will be subtracted further, cost will be understated, and if cost is understated, profit is going to be overstated. Please try to understand that, okay? Listen to me again, rewind and listen again. So if closing inventory is overstated, cost is going to be understated and profit is going to be overstated. So closing inventory and profit are directly related. So now we're trying to correct this. Okay, what happened is there was an extra 1,500 in our profit. Well, you know what we will do? We will put it in our retained earnings. Do you know retained earnings? Yes, I hope you know what are retained earnings. This is where the profit goes. And then the next transaction will be that we'll put it in our general reserve, 20% of that, which is 300. We'll transfer that to general reserve. And so we have, overall, we have 1,200 in the retained earnings and 300 in the general reserve due to this error. There was this overstatement. This is the extra amount. Like this is the mistake. The effect of the mistake is our retained earnings are overvalued by 1200, our general reserves are overvalued by 300. Now when we're trying to fix it, what are we going to do? We'll remove this 1200 from the retained earnings, decrease retained earnings by 1200, and we'll decrease the general reserve by 300. If you try to look at the other options, some of them don't make sense. Increase don't make sense at all. Why would you increase your retained earnings even further up? We have to reduce the amount because our profit is overstated. So we have to remove that. So, and we'll not just decrease it by 300. The mistake was, if they told you it's 1500, then it would have been understandable. You may get confused between A and B. But right now you can just cancel the rest of the options because they don't make sense and you will have the option B available. Let's move on. The bank columns in a trader's cash book and the bank statement both showed a positive balance. Okay, positive balance. They're using positive and negative terminology. So that means in cash book that was a debit balance, in bank statement that was a credit balance. Okay. Uncredited check 200. Wait, a comparison revealed the following differences. Uncredited check 200. That means this was supposed to be added to your bank statement, but it was not added. Right? So your bank statement lacks this 200, it's missing out of the bank statement. Bank charge is not included, and our cash book is overstated by this $10, right? So our bank statement is missing this, and our cash book is actually not considering this yet. So I would say that the total difference between the two is going to be 210. Our cash book is 210 higher than our bank statement. What was the difference between the balance shown in the bank column of the cash book and the bank statement? It's 190. The cash book balance was 210 higher than the bank statement balance. That is true. If you want, you can think about that again. So they are both positive, you know that. But this amount, uncredited checks are supposed to be added to your bank statement. In this case, apparently your bank statement is missing this. And your cash book has an extra 10 in it. It was supposed to be subtracted. So the total difference is, 210. Our cash book has an extra 10, which because it was supposed to be subtracted, it was never subtracted. And our bank statement actually has a lower 200. And so if you notice, the difference here is 210. That's the gap. Let's move on. Number 12. What is the reason for preparing a sales ledger control account, also known as total trade receivables account? To calculate total sales revenue, to ensure trade receivables pay on time. That is indirectly related. To help prepare income statement. No. It can help you in preparing statement of financial position. To summarize the accounts of trade receivables. And this is apparently the best option, right? Because B is related to ensure trade receivables, but it's very indirect. So what you do is you look at your total trade receivables. If it's too high, then you try to contact your trade. But still, it's very, very far away from the right answer. Because if you want to ensure that trade receivables pay on time, you have to look at individual trade receivables rather than the total. So you look at the individual, see how long they're taking, and based on that you contact them. So well, B is not the best option. D is an easy choice in this case. It's a summary of all the trade receivables, sales ledger control account, total trade receivables, because it has the totals of everything. So it's a summary of your whole account. Number 13. Two companies each purchased a motor vehicle for 10,000 at the beginning of year one. Okay, both of them 10,000 each. Okay. Company G used the straight line method of depreciation at a rate of 15% per annum. We have company G and we have company H. While company H used the reducing balance method at a rate of 20% per annum. Okay. What is the difference in the depreciation charge between the two companies for the second year? Okay. So for company G, it's going to be straight line 15% means every year, means year one and year two. Their charge is just going to simply be 10,000 times 15%. That's all they're going to charge. 1,500. 1,500 this year, 1,500 second year. What about company H? They're using reducing balance method. So what we do is we calculate net book value and then take percentage of that. In the beginning, we just take 10,000 times 20%, which is going to be 2,000. In the second year, we will take 20% of not the 10,000, but 8,000. So we'll subtract the first year's depreciation, we'll get the net book value, and multiply that with the 20%. Let me see what that is. 1,600. So company H charges 1,600 in the second year. Company G charges 1,500 in the second year. Okay, H charges 100 more, 100 greater for H. That's what depreciation is. All right, let's move on. Number 14. Amit's financial year ends on 31st December to 31st December. The following account appeared in his sales ledger, Deepak. So it seems like Deepak is a customer. Sales are 3,200. Okay, so we made some sales to Deepak. Deepak is our receivable. We're looking from Amit's perspective. Deepak is our receivable. When we make credit sales, we're going to debit because asset when it increases is debited. So 3,200 was debited. Then Deepak paid some amounts. So what is that? Okay, that's 1,270. Okay, that's the balance. Now, can that be irrecoverable? Look, we are in the middle of the year. Well, it can be. It can be. Let's keep that as an option because that's where it appears. Can it be discount allowed? Well, discount allowed does appear on the credit side of your customer because it reduces your receivables. But do you think we're going to allow 1,270 discount? Like, what is that? That's like around 50% of the, or 30 to 40%. You will never allow that much discount allowed. That doesn't make sense. The balance carried down. Okay, now I was solving this with one of my students and I was a bit confused at first. I was like, these two options, they're both good, and by the way, it's not bad debts recovered. That's completely off the point. And is it irrecoverable debt or balance carried down? Because both make sense. But the thing is, this option does not make that much sense, to be honest. So if you think about it, why would they randomly balance down on November 21st? You see, the year ends on 31st December. This account is for the whole year, January, February, March, June, October, November. Why suddenly in November you would carry down the balance? You would do that on 31st December. You would wait till the end of the year to balance it down because there's still time to go. So randomly in the middle, you would go for irrecoverable debt. Right? So this one's a bit tricky. When I first saw it, I was a bit confused with it. And, there are some hints, like the date, that's one hint. For the discount allowed, the hint is that it's not going to be that big. 1,270 cannot be discount allowed. So, yeah, A should be the answer. Let's move on. Number 15. Sally wishes to increase the balance on the provision for doubtful debts account at the end of the financial year. How should this be recorded? The change. Well, there's an increase. When provision for doubtful debt increases, you all should know that it is an expense, right? That's all you do. The change goes to income statement, the increase. Like previously, let's say it's 100, now it's 120. This 20 will be put into income statement on the debit side, income statement debited by not 120, sorry, just 20. And your provision for doubtful debts will be credited by 20. Does that make sense? I hope so. You just need to know your provision for doubtful debts concept for this one. It's a very basic question. I think these questions are not that hard, to be honest. Number 16. The following errors were found after a statement of financial position had been prepared. A loan repayable in 2 years' time had been included as a current liability. Well, it's a non-current liability. A provision for doubtful debts should have been created. So our current assets are overstated, it seems. What is the effect of correcting these errors? A loan repayable in 2 years' time had been included current liability. So, well, current assets, effect of correcting these errors. Okay. So when we try to correct these errors, our current liabilities should go down. They should decrease. They should not increase. I'm just looking at these two options. They cannot increase. These are wrong. Okay. And so B and D are wrong. And what else? Well, we've already found the answer. Our non-current liabilities should go up. And that's it. A is the answer. You don't have to worry about owner's equity. And you can think about current assets because, well, your trade receivables are overstated. You need to remove that provision as well. So decrease. So it's an easy question again. You just cancel the wrong ones. Because your non-current liabilities will go up, they will increase. And decrease is not an answer, so there we go. This is cancelled, this is cancelled, this is cancelled. 3 options are cancelled. A is the only answer. Easy, right? Number 17. John maintains a full set of accounting records. Why does he also prepare a statement of financial position? So he's maintaining full sets of accounting records. There's okay. Why does he also prepare SOFP? To calculate profit for the year, we make income statement for that. To check if assets equal capital plus liabilities, that is a possible reason. Okay. To show the transactions which took place during the year. Not really. This is totally wrong. To summarize what business owns and what it owes. So, D seems to be a better option, although B and D are pretty close, but that's not necessarily the whole goal of SOF preparing SOFP, just to check your assets, just to check that assets are equal to capital plus. Although it happens as a result. They should be correct, but it's not necessarily a reason, right? It's not a reason. It's just something that happens. It's something that should be true. This could be a reason that SOFP is prepared. It summarizes what we own and what we owe others. Right? It's a summary of that. And like that's the whole goal of preparing SOFP, to summarize that information. Even if you look at your definitions, some of the definitions of SOFP tell you that it's the list of what it's a list of business assets and liabilities. Right? That's what they tell you in the definitions sometimes. Number 18. What are advantages of operating as a sole trader? The owner can keep all the profit. That is true. That is an advantage. The owner can raise finance by issuing debentures. No, they cannot. That's true in limited companies. The owner can make decisions independently. That's true. That's true. The owner is protected by limited liability. No, they're not. 1 and 3 A is the answer. Let's move on. Number 19. Anwar is a sole trader making annual profits of 24,000. He decided to admit Dilip as a partner. They agree that Anwar would receive a salary and profit and losses will be shared equally. Now remember, when you make some profit in a partnership, first of all, you give money to individual people who are entitled to certain shares. Like let's say Anwar is working, right? And so Anwar gets some salary. You get it. The forecast appropriation account for the partnership's first year of trading is this. So we make some profit. We give some money directly to Anwar. That's what we do in appropriation. We give money, or we take money from those, like we adjust the profit a little bit by those amounts. So this is just distribution of profit. It's not an expense. It's just a distribution of profit. Anwar is the owner. We're just giving him 10,000 separately, and then we'll divide the profit. By how much will Anwar's total income increase? Okay, so look, what is he making after the partnership, Anwar? What does he make after the partnership? He makes 10,000 from the salary. That's Anwar. And he makes, well, half of that, 20,000. And he makes 20,000 from the profit share. So after the partnership, he's making 30,000 in total. And before the partnership, he made a profit of 24,000. So he's making 6,000 extra. Interesting question. Please understand that one. Number 20. Kasi and Ravi are in partnership. The financial statements for the year ended 31st August 2021 showed that Ravi was entitled to interest on capital and interest on loan and was charged interest on drawings. So which entries would be made in Ravi's current account? Okay, so if he's entitled, the things he's entitled to will be credited to his current account, and the thing he's charged with will be debited. Simple as that. That's how current account is defined. So interest on capital and loan should be credited to Ravi's account, and interest on drawing should be debited. Remember, if interest on loan is paid, it won't be recorded, but it is part of the question. So if we have to tell them, we'll say that interest on loan will be credited to Ravi's current account, since the question involves that. Otherwise, we won't put interest on loan in the current account if it was paid during the year. There's no need to include that if it is already paid for. But if it's paid, unpaid and due, that's where interest on loan appears on the credit side of current account. Let's move on. Number 21. BCD Limited provided the following information. How much was the equity and the capital employed? Equity, remember, is what belongs to the owners, right? You should remember that in a limited company, equity or the capital is broken down into parts. What are the parts? Ordinary shares, like the share capital, retained earnings, general reserves, all of that belongs to the owners. So when they say what is the equity, we'll say ordinary shares and the retained earnings. Because you remember, if you remember statement of change in equity, or even the capital section of a limited company, these are the things that appear over there. Equity means what belongs to the owners. These are the amounts. 300 plus 200, that's 500,000. What is capital employed? You need to know that capital employed, there are multiple ways to calculate capital employed, but one way is to do equity or capital plus non-current liabilities. And so add all of that up, that's 670. Number 22. The issued share capital of CD Limited consists of ordinary shares. Retained earnings were 86,000 in the beginning and 88,500 at the end. The company made a profit during the year of 26,000, made a transfer to general reserve of 5,000. What was total ordinary share dividend paid during the year? I can tell you that this will very likely come in your exam. I've seen this question a few times now. It's like, a little formula for retained earnings, right? From the beginning till the end. So we start with the opening retained earnings, opening retained earnings plus profit or minus loss minus dividends and minus general reserve, transfer to general reserve, gives us closing retained earnings, right? So we start with the opening retained earnings, 86,000. We add the profit, which is 26,000. We subtract the drawings, not drawings, dividend. We don't know that yet. And we subtract the transfer to general reserve, because all that goes out of retained earnings. And then we get closing retained earnings, which is 88,500. All right, let's find this, this dividend amount. So we'll just transfer that on the other side, bring that on the other side. Let's see, dividend equals, you need to know some basic maths, of course. 86,000 plus 26,000 minus 5,000 minus 88,500. 18,500 is the answer. By using some basic algebra, 18,500 is the answer. Number 23. A sports club was formed on 1st August 2020. During the year ended 31st July 2021, the club purchased equipment costing 5,000 paying by check. In which of the club's financial statement did this appear? So they paid it by check, so receipts and payments is involved. Income and expenditure account will, well, let's see. During the year, the club purchased equipment. So they're not talking about depreciation, isn't it? They're not talking about depreciation yet. If they were talking about depreciation, we will involve income and expenditure account. But here, this is a better option, statement of financial position, B. Because we know that is definitely involved. We're talking about non-current asset. Move on. 24. What is not part of the prime cost of a manufacturing business? Prime cost is all the direct costs. Raw material is the direct material. Royalties is direct expenses. Wages of supervisors, that's overheads, that's indirect wages. Wages of production workers, so that is direct wages, direct expense, direct material. This one is indirect. Okay. 25. The value of Tato's work in progress increased during the year. What does that mean? That means opening work in progress was less than the closing work in progress. Closing work in progress was higher, basically. This was recorded in his financial statements. How did this affect the cost of production and the cost of sales? Now look, when you have work in progress, uh, you have some cost of production. What you do is you add the opening work in progress and you subtract the closing work in progress, right? In this case, they're saying that the closing was higher than opening. That means the subtraction was greater. So cost of production will actually decrease. And if cost of production decreases, the cost of sales will also decrease. They're both directly linked with one another, because cost of production is basically the cost of sales in a manufacturing business. You must understand what they mean by this when they say work in progress increased during the year. They mean that closing is higher than the opening. So whatever your cost of production is, 1,000, you add something to it, but you subtract a greater amount. So let's say you add 100 to it, but your closing work in progress is 200, and you subtract 200. What happens to your 1,000? It becomes 900 now. Does that make sense? I hope so. Please try to understand that, make sense of it. 26. What are the advantages of keeping a full set of accounting records? All right, financial statements will be free from errors. We can have full set of accounting records and still have errors. So that cannot be right. It is impossible to make fraudulent. Impossible? Really? No, it's not impossible to make fraudulent entries. It is possible. More informed decision making is possible. Yes, we have more information available. Our decisions are more informed. The calculation of profit is more accurate. It's not. They're not saying it's 100% accurate. It's more accurate than as compared to not having full set of accounting records. 3 and 4, option D is reasonable. Let's move on. Number 27. Beth provided the following information. Net assets. What is the other name for net assets? Do you remember? It is capital. Capital equals net assets. So opening capital, closing capital. Her drawings for the year are given. If you watched my previous videos, I call something. I say some. I call a thing magic formula, right? There's a little formula that goes on. So you start with the opening capital, 28,000. You add profit or loss, we don't know. You subtract drawings, and you get the closing capital. Let's just find x. It's going to be 24 plus 3 minus 28. That's negative 1,000. When the answer is negative, it tells us it's a loss, 1,000 loss, right? Let's move on. Number 28. Roche, and look, I'll briefly explain this too. So we start with the opening capital. We add the things that are going to increase the capital. So x, it can be addition or subtraction. In this case, it's subtraction actually. And you subtract the things that reduce capital. So you see we've subtracted the drawings and we got the closing capital. And then we just do some algebra to solve that. 28. Roshan's sales for his first year of trading were 55,000. His gross profit margin was 20%. Okay, sales are given, margin is given. We know now we can calculate gross profit easily. The closing inventory is given. What were the purchases? It's his first year. There is no opening inventory, guys. So with the given information, you can find cost of sales. So look at that. Sales, cost of sales, gross profit. Sales are 55,000. Cost of sales unknown. Gross profit unknown. But we know, gross profit is 20% of the cost. Sorry, the sales. So take 55,000, divide by 100, multiply that with 20, you get 11,000 here. So 55 minus 11,000 is 44,000. That's our cost of sales. 44,000 is just the cost of sales. And now we need to calculate purchase. How do you calculate cost of sales? You do opening inventory, which is not there, plus purchases minus closing inventory, which is 3,200. That gives you cost of sales. And so purchases equals 44 plus 3,200. That's 47,200. D is the right answer. Let's move on. Question number 29. Which information is required to calculate the return on capital employed for a sole trader? ROC. We need the profit, operating profit for the year. That is profit before interest. We need operating profit. And we need now to calculate capital employed. To calculate capital employed, one of the ways is to add non-current liabilities and owner's capital. You add them up, you will get your capital employed. You put that above your capital employed and you have your ROC formula. So C is the right answer. That's what you need for that return on capital employed formula. What is the best indicator of liquidity of business? The best indicator of liquidity. Well, current ratio and liquid asset test ratio are two liquidity ratios here. We also have working capital, but this is in numbers. This working capital is just current assets minus current liabilities. So that's not the best one. It's just in amounts. It's not really a ratio. To return on capital employed, that is a profitability indicator. Now we have the choice between current and quick ratio, or acid test ratio, or liquid ratio. We'll go for the liquid ratio because it only considers the liquid assets. Inventory is not considered a very liquid asset because it is 2 steps away from being cash. So this is the best option. Liquid ratio really shows you whether we have a good liquidity position or not. Because in current ratio, inventory is also included. What if we have plenty of inventory? So if we have plenty of inventory, we are not actually that liquid. This formula avoids that problem. This formula does not include inventory as a liquid asset. A trader provided the following information for the year ended. We have opening trade payables, closing trade payables, credit purchases. What was the trade payable turnover? Okay, so we need credit. What we need to do is we need to take the trade payables on that date, the closing date, over credit purchases during the year. They wanted a number of days, so multiply that with 365. When you need something in percentages, you multiply with 100 because percentage is always out of 100. When you need something in days, you multiply with 365 because there are 365 days in a year. 42,000 divided by 319,375 times 365. Be ready with your formulas in the exam. Okay? You must memorize because they're coming as it is. They won't be tricking you with the formulas. And it's a logical thing to take the closing one, not the opening one. Because we are talking about the year end. 32. A business provided the following information about its gross margin. Margin is high, getting lower, getting lower. What could explain the changes in gross margin? Cost of sales is actually rising. If it was decreasing, then we would have a better margin. Expenses are decreasing, nothing to do with expenses because we're talking about gross margin. Expenses come after gross profit. Quantity of goods sold is decreasing. Quantity is not a problem here, right? It's the profitability that's changing. So if we sell 1,000,000 pieces at the same price, at the same cost, your margin is not going to increase or decrease, right? If you sell 1 piece or 100 pieces, the quantity doesn't affect your ratios. The price itself does. If your selling price is falling while your cost is not, that means you're making less and less profit on each product, on each piece, right? So this is the right answer. 33. What is not a limitation of inter-firm comparison? So when you compare two firms, there are some limitations, there are some problems with it. Accounting records do not include skills of workforce. Now that is a legit problem with comparing two businesses. So that's not a limitation. That is a limitation. Businesses may have different accounting policies. That is the limitation. They have different accounting policies like depreciation, so it's harder to compare them. Business may have different sales prices. That's not necessarily a problem. We'll look at the next option. The available information may not relate to a typical year. That is also another problem with inter-firm comparison, that perhaps 1 year is too good or 1 year is too bad. So you cannot compare two businesses' performance just by looking at 1 year's data. So something as tiny as a sale price does not really pose any problems with comparison, right? Like if two businesses have different sales price, we cannot say we cannot compare them. That's not a problem while comparison. We can just calculate some ratio. We can calculate margin and markup and then compare those. So different sales price is inevitable. Every business might have different sale price of different products. That does not mean we cannot compare their statements, financial statements, right? All other options you can, I think most of you can easily recognize that these are problems with comparison. So cancel those, and this is not a problem with comparison. 34. Why would a supplier be interested in financial statements of a credit customer? To know if customer can pay what he owes? I believe yes, that could be right. To know the amount owed by trade receivables, to know the profit for the year, to know value of inventory. They all don't make sense because profit for the year can be high, but cash can be low. They are looking for whether the customer can pay us or not. So that is very, very straightforward, very logical. Someone who doesn't even study accounting can answer this, because it's very logical, extremely logical. A supplier looking at customers' data, financial statements, just to see whether the customers will be able to pay or not. Well, one confusing option is this one, profit for the year. Well, they don't care about the profit. They care about what we have in the bank account. Do we have enough liquidity to pay them? Because a business can be profitable with cash flow problems. 35. What does the objective of understandability assume users of financial statement will possess? A reasonable knowledge of accounting, which sounds like a good option because that's what we expect our users of financial position to have, a reasonable accounting knowledge. Full accounting knowledge? No, we don't expect that. They're not accountants. Knowledge of bookkeeping but not accounting? Well, they need to know some basic accounting, like how to read financial statements. No knowledge of bookkeeping or accounting? No. If they are totally unaware of what is bookkeeping and accounting, they can't really understand our statements. So they must have a reasonable, not a very deep and not a very little knowledge, but a reasonable amount of knowledge of accounting. That's what we assume while preparing our financial statements. And that is it for this paper. Good luck with your exams, everybody, and have a really nice day. Goodbye.